What if the Federal Reserve's next move isn't what everyone anticipates? Imagine a scenario where the expected interest rate cut is not the real game plan, but rather a smokescreen hiding a more sophisticated strategy. This potential twist in the tale revolves around the proposed changes to banking regulations, specifically the Supplementary Leverage Ratios, or SLRs. The Federal Reserve continues to publicly fight inflation, a battle led by figures like Dallas Federal Reserve President Lori Logan. Logan's recent statements underscore the possibility of maintaining or even hiking interest rates if the financial conditions ease too much. This public stance seems to be a move to keep inflation in check. But behind this public front, a stealthier strategy is being crafted, aimed at supporting the financial system. The International Swaps and Derivatives Association's recent proposal to alter the SLR formula is a key part of this strategy. By potentially excluding U.S. Treasuries from the SLR calculations, banks could face relaxed capital requirements, prompting them to purchase more government bonds. This move could indirectly lower interest rates and stimulate the economy. It's like quantitative easing, but without the explicit label. Traditionally, quantitative easing involves the Federal Reserve buying large amounts of government bonds, injecting money into the system, lowering interest rates, and boosting economic activity. The proposed changes to the SLR have a similar effect, incentivizing banks to hold more government bonds, which could lower borrowing costs broadly, creating an environment of monetary easing. This covert approach to monetary policy could have far-reaching implications. It could erode the transparency and trust that underpin financial market stability. Investors rely on clear and open communication from central banks to make informed financial decisions. Covert actions can compromise this trust, potentially leading to misguided investment strategies and financial instability. While this strategy might help dodge immediate financial crises by artificially maintaining low interest rates and promoting lending, it could endanger long-term economic stability. By potentially fueling inflation and asset bubbles, these actions could lay the groundwork for more severe corrections in the future. In light of these developments, investors might need to rethink their strategies. As the hidden impacts of these regulatory changes unravel, traditional investments in bonds and equities could behave unpredictably. Investors might need to look towards tangible assets or commodities as hedges against inflation. Moreover, it becomes crucial to monitor the real effects of these policies on asset prices and economic indicators. In summation, while the Federal Reserve's public fight against inflation continues, a hidden strategy involving changes to banking regulations could be in play. This strategy, akin to quantitative easing, could indirectly stimulate the economy by lowering interest rates. However, this covert approach might erode market transparency and trust, potentially leading to misguided investment strategies and financial instability. As these developments unfold, investors need to stay vigilant, consider their investment strategies, and keep an eye on the real effects of these policies.